what's interesting is that we have bulk of the interest still coming from the foreign investor at this stage. Why are local investors still holding back?
Good morning, Alicia. Thanks for having me. We've seen that the demand on the local boards has been driven primarily by foreign institutional investors. I think the significant indicator here is the fact that this set of investors do have significant amount of liquidity. That said, your question regarding the dearth, as it were, of demand from the local retail space, I think largely is a follow-on from the fact that there has been not much of a connect between the liquidity that we've seen awash in the Nigerian system and the actual purchasing power of the retail investor. On the domestic institutional side, and we'll find that the PFAs, who constitute the bulk of this class of investors, as well as the insurance companies themselves, seem to be either holding off on making new purchases or primarily just taking profit from this recent surge in the index.
To what extent are locals then running the risk of missing this opportunity boat completely if they don't get in now?
Well, we think, given the current valuations in the market, there remains some significant upside. From our view, we think the index may close around the 25,000 mark, between 25 and maybe 27,000 mark by the end of the year. That will be obviously attributable to a number of factors. Q3 results, which we expect to be strong, at least from the banks and from a good number of the pharmaceutical, from the FMCG players. But like you said, even though they haven't come in yet, we think that there has been a pickup of interest, at least on the local side. We have also found that part of the challenge regarding purchases by domestic investors has been the fact that for the stocks that outside of the banking space do make for attractive valuations or look attractive for purchasing, the free float available from a shares outstanding perspective remains rather limited, and it's being held by the PFAs, as it were.
Within the banking space, though, let's focus in on Oceanic here. I mean, it's been the first to get swept up in the positive momentum here. It also means, though, that one would assume we'd see a change in valuations on this counter happening fast, and that driving the demand that we've seen over the past 3 days.
Yeah, indeed. I think the news regarding the conviction of the former CEO of the bank, and of course the plea bargain that's seen her pledge to basically return about $1.2 billion to the bank, has been a very positive development on that front. Given the fact that the bank is in negative equity currently of of a similar tune, what that means, or the implication of that, has been the fact that were that money to be injected directly into the bank, quite clearly the valuation story changes. And that obviously makes it a much better attractive proposition, either for the bank itself to move forward or for whatever talks may exist currently from an M&A perspective. I think the knock-on effect of that has been felt on some of the other institutions, notably Bank BHP, Unity and Intercontinental. I think the thinking, which has obviously driven the bullish demand, is the fact that where such similar cases to be recorded with the CEOs of the other banks who are still undergoing trial, investors believe that probably there may be little of a need to have the AMCON intervene directly, as it were, by injecting new equity, or having the banks go look for new equity, as it were.
On Oceanic specifically, I mean, to what extent had that bad news been discounted, and how much more upside do you see on the stock in the short term?
Well, it's been on the surge for at least 3 days now, and I think looking at it from a price-to-book perspective, currently there wasn't any of such, given the fact that it's currently about 150 billion negative equity. With 190 billion coming in, it quite clearly changes the story. And then even if we were to discount all of those assets, as it were, for either liquidity or for a surefire sale, we still think that it should be in a position to recapitalize the bank significantly. What that does is that it makes the whole picture for Oceanic Bank different, in the sense that rather than having to go look for this minus 1.2 or 1 billion in equity, the money comes in directly, though it will be obviously managed by the AMCON in order to ensure that the assets are optimized. We think that what that would do for the bank is the fact that it then makes it imperative. It then makes it possible for the existing shareholders to basically re-strategize and have the bank, back on its feet and trading without necessarily having to get into an M&A deal scenario.
Victor, what's interesting is that some attention seems to be cast over some of the mid-tier banks as well, where yes, they may not be boasting as hefty a balance sheet as some of your tier 1 banks, but where on an operating and performance metric, there doesn't seem to be much of a gap that needs to be filled.
Yeah, that's precisely the case. From our view, we think that some of the first-tier banks have been primarily overbought, quote unquote, even though also the valuations are on the low, as it were. For the mid-tier banks, we still find that a good number of them operate with similar metrics, if not in some cases better than some of the first-tier banks. And notably among these, obviously, would be the likes of Access. We've got Skybank in that category. We've got Diamond. We've got ETB, and I think what the story is particularly is the fact that given that the whole banking scenario has changed with respect to the modus operandi, the fact that some may choose to go the monoline banking route, while some may choose to do, hold on to the group holding structure. For the mid-tier, a good number of them. From a subsidiary perspective, do not have a significant contribution to either turnover or net earnings. So quite clearly, in the event that they do collapse their operations and just focus primarily on commercial banking, given the clientele and network that they do currently manage, they do present very good potentials for shareholder returns, and obviously for any market investor who takes a decent position.
Let's take a look at Access Bank there, because we know that this has been a bank to have a strong focus on IT and e-banking. How much headway has it made in actually going down that route? Because what they're looking to do is actually leverage off their existing clients when venturing down this new path.
Access is a bank that primarily hinges its growth strategy on what it calls the hub and wheel spoke design, where it leverages on the existing corporate clients and their own value chain. So they would refer to it as a value chain banking model. They have obviously had pretty decent showing in the e-banking and the corporate platform. They are looking to expand their retail operations, and I think one of the key features, notably in the recent past, has been the fact that they have recently appointed a new chief risk officer, who prior to now was at the Guarantee Trust institution. What that does for any keen observer is the fact that it lends credence to the fact that the bank is serious about corporate governance, about risk management, is looking to find ways to ensure that it more efficiently optimizes its balance sheet.
And I guess, Victor, that's very important in a context where we've got the investor mindset having shifted from pure profits to ability to actually leverage off profitability and operational efficiency to actually squeeze more earnings from less. We're going to